Hello guys, and glad to have you on board again. This is going to be TL number 12. We're getting right into trend following. The previous video was just to introduce the knowledge, just make sure that you understand the basics of those things that are going to roll over and over again as we get to talk about trend. Let's just make me a quick recap out there. We're going to talk about fourth range boundary multiple times. We're going to talk about breakout strategy, generally breaking the third range boundary and trying to buy the fourth range boundary. We also introduced the multi-time frame operative sections in which we're going to have to navigate through 3 time frames. The built-in systems of my algorithms just already take care of 2 time frames, and in some cases can deal with 3, but you're going to have to activate some advanced features of the indicators. We'll eventually get to talk about it into a separate video. Okay, so what you need to be understanding in there is that we're going to need to switch time frames. When we deal with time frames of trending context, we're going to have to switch from one time frame to another because we just have naturally 2 time frames displayed on the charts, meaning that if we need 3, we're going to have to change, okay? Simple as that. There is also one notion I wish I could have been more explicit about, is this fourth range boundary, okay? Because some people already message me, all right, Phil, we're supposed to trade the fourth range boundary on the PDF manual. This is an expert context, and it definitely is. So we're going to explain a lot of this. Today we're going to be talking about accumulation, which is the first step toward a trend emergence, which means we're still not yet trending. Basically, the accumulation is the very late stage of a ranging structure before it actually switches to trend. Remember what we've said on the previous things? Anything prior to the breakout is not a trend. It's a late stage range, which definitely isn't to be dealt with like a trend. So we're not yet into trend. We're into something in between late range, early trend possibilities. Okay, so don't consider that accumulation trades are granted. These are the natural imbalance that is supposed to take place before the breakout occurs. Some breakouts will occur without accumulation. Some accumulation won't cause breakouts that definitely follow through. Some accumulation will cause fake breakouts and rapidly will reintegrate back into the range. All of those things are the natural chaos behaviors of markets. There's nothing that is ever going to be 100% guaranteed. So today is going to be explaining how the probabilities behave from one of those things to occur more than the others. What are the technicals that will help risk limiting you to be proven wrong? Pure and simply, favoring odds for you to be into the right track without ever knowing any such a thing, okay? That being said, let's switch to our PowerPoint support today. All right, let me just gather my versions. Okay, so you might, of course, be familiar with that, and anytime we learn a context, we're going to start with this thing. So the accumulations are trend following trades, which means they're intermediate level of risk taking and progression through the strategies. So these are all those yellow dots you can see out there. So accumulations are the first of the 3. We're of course going to be dealing with the breakout, very likely going to be the next prospective NTL number 13. And you also have to learn pullbacks that we're probably going to put right later on. Anyway, so accumulation is the first of these series of 3 stops, 3 steps of maturity of a trend, and there's of course some more intermediate stuff on the shorter time frame, but these are other patterns we'll get to learn as well in the process. So still ranging, maturing the range, and imbalancing the stuff, getting toward breakout later on is what we talk about. Okay, so accumulations happen in here and in here as well. They are the patterns that comes from mature range, and they need to lead to breakout eventually. Okay, but the first rule is, of course, this is a multi-time frame pattern, because if you guessed that, that's the first time, and let me be clear, probably one of the only cases scenario. Some pullbacks will eventually be down this road as well, but most of the time this is just accumulation. We'll be trading the trend channel. Oh God, didn't you tell me that the first strategy rule is always trade in a context? So what am I supposed to do? And by the way, you told me about this fourth range boundary yesterday, or I mean in TL number 11. So what the hell's going on in here? Now you just tell me I cannot trade the fourth range boundary? Yes, exactly. You can't trade the fourth range boundary on the context because that is an expert trade. But you can trade this exact same fourth range boundary that happened in here on the lower time frame, but on the higher time frame. You're going to be dealing with that not in the context time frame, but in a trend channel time frame. And this is where you need to understand. All of this is a layer, okay? Remember that the trend channel is no more than the context of the lower time frame, okay? So if you're in a daily chart in here, if this is a daily chart, then this is the 4-hour chart's context. So yeah, you basically are going to trade the fourth range boundary of the lower time frame, but you're not going to deal with that fourth range boundary all by itself. You're going to deal with the equivalent of it on the higher time frame. And that is a definitely much different risk taking, because risk taking with this trade, even though if you zoom it out to the higher time frame will be the equivalent of this area, then actually dealing with an H4 signal is much more risk-taking than taking this daily signal instead. Because the risk limitation we're going to apply in here is totally different with the one I'm going to teach you on the experienced stuff we'll see much later on into this series of courses. Okay? So that's something that could have been a blurry area, and I definitely wanted to make these things clear. We don't trade the fourth range boundary. What we trade is the fourth range boundary equivalent on the higher time frame. Okay, so you need to understand that this is absolutely crucial way of understanding the pattern. This is the only time we're going to trade within the trend channels boundary instead of context. That's the only alteration of the first rule of the strategy. Always trade in a context. But as we will trade the trend channel, we will have a look at what happened in the lower time frames. That's the reason why I told you we're going to have to switch the chart's time frame to verify informations. Okay? So you also need to understand that the local time frame must be a range. We are accumulating only if we have a mature range. There are no accumulations of structuring ranges. So you need to have a 4+ range boundary structure within context visible prior than thinking of any possible accumulation to occur. If the range is not mature yet, there's not going to be any accumulation. So don't mix things up. And so many people make the mistakes of forgetting about it. So you need to clearly see the bottom or the market top, which is first range boundary, the second, third, the one you know about, and it's after the third, when you retrace to the opposite context, the fourth range boundary, okay, that at that point the accumulation gets set itself. Okay? Absolutely important that you guys understand that. You need to be dealing with at least the fourth range boundary. It can be 4+, 5, 6, 7, whatever, just at least number 4. Okay? The other structural pattern in here is that, of course, you must not reach to the opposite boundary, because if you get out there and your fourth range boundary on the lower time frame reaches out the context, then that's not an accumulation, because you just reached out to an opposite range boundary, which means you were dealing with the fourth and you're now dealing with the fifth range boundary. So if you want an accumulation, you must fail to reach out the opposite context. Absolutely necessary structural things. So many people forget about this, okay? And the final rule we're going to set in here is very important, as you get to understand that we're still dealing with ranging context. That's absolutely crucial. Remember that the trend only emerges after the breakout. So anything that happens in here is a ranging context. So accumulation is still a range. And you must remember that the context channels I've built, okay, which are the equivalent of parallel channels that you can use, and we'll make a specific video about it to help you using free tools available in every trading platform, trend channels, pitchforks, whatever, to replicate the structures and rules I teach you out there, okay? Once again, the indicators are an accessory stuff for those who can afford them, no more than that, okay? They're not mandatory. If you want to apply my strategy, you can definitely do it with free tools. Just requires a little bit more understanding and some hand-working stuff, okay? Anyway, that being said, my channels have a concentration effect, okay? They have the fear of the impatience biases right built into them, because investors are naturally impatient. We all work around impatience biases to control them, but we don't destroy them. So this is the reason why all my channels are converging. They're accelerating. There is an acceleration factor in them, which means they never stay parallel forever. They will always start parallel and then start to concentrate. So time is of the essence for my context channel, but the range can last as long as it fucking wants. Remember what we've said about that on the third range boundaries and stuff. So we've introduced a third element to risk limit these probabilities of the context channel to lead you into the wrong direction. And that is Fibonacci retracement. And we're going to have to use those Fibonacci retracement in here as well to guarantee a minimum level of retracement before looking for accumulation. The bare minimum is going to be 23%. There's not a single trend following context that occurs without 23%. Okay? It's absolutely necessary out there. But the general rule in here is, like we said, for ranges, we're going to look for 61 at least, and sometimes even more, and look for 76%. Accumulation, as they are imbalanced within the range, are going to require lesser numbers. And the statistics in here showed me that the most probable context, almost 2/3 of them, are between 38% and 50% retracement. So that is a strong cluster zone in which most accumulation occurs. Sometimes some may dip down to 61%, but they generally don't last very long out there. And some, very rare cases scenario, happens between 23 and 38%, but they require generally some external catalysts, like the market being fueled by much more demand for some more logical reasons, even though speculations might be among them. But generally that means fundamentals are pushing prices if you have a less than 38% Fibonacci accumulation. Okay? So that is how you figure out the speculative area, okay? You trade the trend channel, not the fourth range boundary, but must be a lower time frame fourth range boundary out there. You need to wait for at least a 4+ range boundary as well on the local time frame, okay? So 4 times between the context, then 4 times between the trend channel, and here is where your accumulation takes place. If the lower time frame's fourth range boundary is built between the 38 to 50% Fibonacci level area, which is a cluster, can go down to 61%, some specific cases, but a bare minimum 23 in any fucking way. There's no accumulation that retraces less than 33%. Okay? Absolutely necessary that you guys understand that. This must happen without reaching the opposite context. Okay? Absolutely necessary. All right, now let's get to risk management. So just like we figured out, there was 2 ways we can manage the third range boundary with 2 different risk limitations required to enter. Just as a glimpse of a reminder, we do wait for a neutral range boundary for at least 76% and below the context to get to look for the speculative area. Just like on trending ranges, we are able to trade right in the context, but still with a bare minimum 61% retracement. And we also introduced the fact that we needed a trend signal to risk limit this excessive or slightly tighter risk taking that we make by buying or selling inside the context with a lesser risk limitation from Fibonacci's. Okay, so we compensate both of these more risky approach by risk limiting with a trending signal. Then we're going to do the exact same thing in here. As we increase risk taking on the fact that we trade in the trend channel instead of a context, we're going to risk limit that both case scenario using a trend signal. Okay, this is what these arrows represent. So these arrows represent the fact that we're going to need for trending signals. Okay, we need for a Fibonacci cluster. Okay, this is not trading a Fibonacci level in here. It's just like generally we're not going to buy the 38%, just like not buying the 50%. It's not buying the Fibonacci cluster level. It's just buying an area that generally tends to be at least 38% and can go right down to 61. It's just something in between, the biggest amount of odds being between 38 and 50. Okay? What we're going to see out there is just 2 different ways, okay? We're not going to figure out the neutral accumulation and trending accumulation. We're just going to say there are accumulation that will behave in the way the market was going previously, which means the previous trend was bullish, we've consolidated, and we're going to accumulate ahead of the same type of breakout, breaking in the same direction, okay? And there are some other ways in which accumulation will go the opposite way. We start with a bearish movement, we build a range out of a bearish income, and then we break out of the range to the upside. We reverse the incoming pattern structure, okay? So it will basically set two variants, the accumulation following the preceding trend and the other ones reversing them. So of course, one is going to be riskier than the other, just like we've stated earlier, okay? Just like for the neutral ranges and trending ranges, the accumulation with a reverse is going to be more aggressive, riskier. And just to give you a glimpse of statistics out there, probably 2/3 of ranges behave this way. They do get to break on the same side of the previous incoming trend. Okay, we've built a range, we came from a bullish trend. Most of the time, 2/3 of the time, we're going to break into the same direction later on. Okay, but that's not a certainty, and 2/3 is definitely not enough to consider this as one battle. We definitely need to take care of this remaining third option. Okay, and of course, as the first one is riskier, okay, this one, we're going to apply some different risk limitation out there. The speculative area will be the same, definitely will be the same. I've noticed that the retracements on those patterns are generally slightly more and deeper than the others. So these are the patterns that can much more often get to retrace 61%. Okay, so that's something I just bear in mind. Okay, anyway, but what matters in here is that, of course, as one is more likely to occur than the other, means the one is, of course, riskier than the others. And I would definitely recommend that if you're beginning with the strategy, just try to avoid trading the reversals ones, just because they're less probable and therefore they can be more tricky. There are far more false flags of accumulation going on reversal context rather than following the previous trend. So it's not this thing of stupid, man, trend is your friend, and if the market was bullish, it's very likely going to be as well later on. That's definitely bullshit, okay? But like we said, 2/3 versus 1/3 is still something that you better like to have on your side. So when you see opposite direction, reversal type of accumulation, if you don't really feel like the signal is real clear, whatever, if there's any doubt, just get the fuck out of here. You still have plenty of trend following opportunities. The accumulation is definitely crucial for a very, very nice, rewarding trend following, but it is not a mandatory stuff. So when you're getting to learn a context, if anything feels like blurry or whatever, if there's any doubt, just goddammit, wait for the next step, the breakout. It's definitely the most rational decisions you could make. Okay, now finally, we're going to jump into a real market condition type of class. And of course, as you get to learn this thing, you need to understand that this 30-minute video is definitely not going to be enough for you to master this thing. Okay, it takes some time to process, and it requires real market practice and real tough risk management into real conditions to actually totally master these things. So I'm going to give you the guidelines, the introductory stuff that will get you into this pattern as safely as possible. And of course, practicing will be key to understand these things, because some of the rules I'll teach you are like the rules for a perfect accumulation trade, which is not necessarily going to be the case each and every time. Okay, so later on, I'll teach you how to bend some of those rules without bending everything. You need a frame to work with. And yeah, later on, I'll teach you how to overcome some of the issues of imperfect signals you might get. But anyway, here's what a perfect signals look like when you get to trade those things. And these are the ones you must look for when you get to learn the strategy first, okay? So the first things we've assessed previously is that as we trade the trend channel, we want a trending signal. That is not a maybe, it's really mandatory at the beginning, okay? Some rules will allow you to alter these things, which means, for example, if you have a cycle breakout followed by a range signal, this can be okay. But in this case, it has to occur at a Fibonacci level, not just near or in between of nowhere, okay? So if you have cycle breakout, Fibonacci level, and range signal all happening in the same thing, that's okay for a trending signal, okay? What we're going to be needing to go with risk management is how much money do we put into these patterns, okay? And of course, this comes with risk-reward ratios. But in order to figure out risk-reward ratios, you need to know how much you're willing to risk and how much you can take out of these patterns. So Let's start with how much you risk first, because that's the easiest one to handle. How much do you risk? And I would say don't make it overcomplicated. The easiest way out there is to use the same pattern as we used for the range. We're still in a range, so let's figure it out simple as possible. Use the trend channel's width. So you take the reference width of the trend channel and you know that your stop loss must be this approximate size. Okay, so in here you would say, okay, here is the signal, here is the approximate stop loss sizing. All right, let's put a stop loss out there. You can use another rule, which is basically put it either above or below, that depends on the side of the accumulation, the previous range boundary. Okay, like for example, in here, our range is first, second, third, fourth range boundary, and here's the fifth. Okay, so as we're working around the fifth, you can protect yourself down the fourth range boundary, pure and simple. Okay, and in this case scenario, it is actually the same area. If you take the trend channels width and the fourth range boundary, they all lead to this cluster out there. So yeah, you can put it. That's definitely working around the stuff. Okay, so that gives you an approximate maximum risk taking. Okay, then in terms of potential reward, I'll just give you an approximate level of, average calculations I make. This pattern averaging will give you an approximate 1 to 5 risk reward ratios in terms of returns. But of course, that means you're going to have to let those trades open for a long time. So if you rise the stop loss too quick, if you want to protect some gains and stuff like that, you are going to destroy that risk reward ratio. So the optimum risk management for this trade is not to try locking on the gains, is to leave the stop loss at break even for as long as possible. That also means that this must not be forever. I'll teach you later on, and specifically when you get to the pullback third range boundary is where you want to lock on the gains for these trend follow trades. So today, let's just take it for whatever it is. Okay, you're going to understand all of it when you get to learn the entire trend following process structure. So just take it as it is today. It is a 1 to 5 risk reward ratio if you put the stop as break even and don't touch anything. You don't make partial profit taking, okay? You just leave the entire position open, and the only risk management you make for those trades is not locking 50% gains just because you really want to make a gain right now rather than later. You're taking a limited amount of risk, but let it fucking open as long as possible. The only things you do is putting the stop at break even when the conditions will be necessarily met, okay? And if you do that, you're going to get an approximate 1 to 5 risk reward ratio for those trades. Of course, that doesn't mean the 5 first trades will be making gains. Some of the time in here, the outcome for these trades is you lose it all. Most of the time, either you lose it all or you make a big gain. Because you're going to leave this trade open as long as possible, and either it's going to be a success leading to its profit-taking area and you're going to lock on some nice gain, generally a 1 to 10 ratio, but most of the time you're going to get stopped at break-even because the trend didn't work out. The breakout failed and the market retraced or something like that, and you're just going to be taken down the market. So most of the time, it's going to be oscillating between these two options. Very nice gain, or you take it all off the table and you lose it all. So don't be dumb. Even if you lost it all for 3 trades in a row, don't be dumb to cut it off the next time and say, man, the last time 3 times in a row I made $500 and then it all turned down to 0. Jesus, motherfucker, this time I've got 400. I'm going to take it all. That's stupid, because that's exactly the time in which you will make 2000s. So don't do this, okay? Just let this trend ride as long as possible. We're going to do some psychological management later on because it's going to be absolutely crucial. So there will be a psychological trading lesson later on into the trending behaviors because we're going to have to manage these problems, okay? So anyway, that is for the target. Now let's talk about validation level. I suggest, just like in the range trades, keep up the rules as simple as possible. We're still in the range, so use the same validation setup. The validation is reaching out the opposite trend channel. As you get to buy the signal in here, you will go right up there, okay? And as you reach out the opposite trend channel, just take the profit. Just validate the trade. So like I said, don't take the profits. Just let them as long as possible. Okay? Confirmation will be closing the context boxes. Okay? So when the context terminates and creates a new box, just look at the close. If the close is made either inside the context or outside of the range structure, remember that you need to deal with a mature range, so you should be able to draw trend lines. So when the context is closing outside or inside the context, you know that your confirmation is meant. At that stage, put your fucking stop at break even and just move on with another trade. Just let this trade exist as long as possible. Just don't try to profit take it, okay? Just like that, we're also going to assess signs of potential invalidation. When you got into the trade, but actually at some points, things don't behave the way they should. Either the market fails to validate, or the market oscillates right after validation, it fails to reach out confirmation. Some signs of invalidations will be reaching out the opposite context. Like, for example, you get in here, okay, and the market fails to react, it's going flat, and it reaches out the context. That's generally not a good sign. Even if your stop loss isn't yet triggered, it's recommended to either shrink the position sizing, partial profit take, or take half the position at break even at that point, but limiting the risk taking if the market enters the context is one thing you should consider, okay? Just like making more than 61% Fibonacci retracement, generally not a good sign, okay? So if you want to reduce the position sizing or even take the entire trade off the table, these are the things that can eventually be rational decision-making stuff, okay? Closing the context time frame below the 20-period moving average is also one sign of the market doesn't really want to go up or down. Though the 20-period moving average on the context time frame is going to be a crucial element for us into trend following. I haven't been talking about it yet, but we'll eventually later on, specifically for the pullback trades. So the 20-period moving average can be a sign. And remember that we care about when the market closes the box. So in here, it was there. So did the market close below the 20-period moving average? No, it didn't. It gets below it. It got below it, but just managed to close right back in. Same thing goes for the next close, which was in here. Even though we dipped below, we failed to close. So that is what I meant by closing below the 20 moving average for a bullish accumulation, of course, and same things goes on the opposite way for the bearish accumulations. Okay, the targets, we already talked about that. Just keep it as long as possible. I'll teach you later on where to profit take those patterns. Okay, so what matters with this thing is that you understand that you need a trending signal. And oh, by the way, haven't you asked yourself the question, do we have a trending signal on this chart in here in this example? Do we? I mean, I don't see any of it. The trending signal is supposed to be a blue signal. I see the blue background motherfucking coloration stuff. What that is, I don't know. All right. Although I'll let you know that this is cyclical validation for sine wave. So sine wave was okay with a dip being built out there, but do you see a blue pattern? Man, no, I don't. So what is this? Oh, shit. Sorry about it. I totally lost it. Okay. So what is that feel? There is no blue signal. So where is your trending signal? Okay. So first of all, you wait for the confirmation. That's absolutely necessary. So what I care about is mostly this blue triangle. And then as the blue triangle shows up, I'm smart enough. I know that any algorithm isn't perfect, and that is exactly the case in here. There is no pattern, but there is one. If the momentum makes a new low point without making a lower low point on the prices, that is a hidden bullish divergence, which is a trending pattern. So yeah, sometimes you're going to have to work a little bit on your own. In here, there is a pattern. It's just that the algorithms didn't detect it. But it still exists, and it's fairly much there. You could definitely see that the momentum is broken to new low. Look at the prices. We were far away from making new lows, and we were dealing with a trend channel. So remember that you don't analyze market behaviors and momentum behavior unless you have a triangle. So when this triangle shows up and is closed, so this is where you make this analysis, you would say, oh man, the indicator didn't show the signal, but there is one, and I can take it. Remember that you don't trade the fourth range boundary on the lower time frame, okay? But you can zoom into the lower chart time frame to look for a signal. Normally, there should be a signal in the fourth range boundary signal. The better the signal, the better the risk limitation will be. Like if you've got a nice exit pattern, whatever, into this lower time frame signal, that is definitely good for you. But what's a mandatory stuff is to get a trending signal out there, because this is what you trade. Okay, the fourth range boundary nature is something that is going to improve the quality of the signal, but what's mandatory is the trending signal. If you've got this without a trending signal, then there is no accumulation. In here, it's non-detected, but it's definitely there anyway. Okay, So yeah, that's it for today. I think we've got more than enough information to switch to conclusion. All right, guys, so if I have to sum up the core information, absolutely mandatory stuff to remember out of this perspective. Remember, this is just a global course to set the guidelines for you guys to work this into real market territory. The risk limitation and risk management isn't something out of straight rules that you're gonna have to follow, because most of the time you will have imperfect signals. So it is by practicing and learning how to safely bend some of the rules, not bending all of them. The more you bend, the more danger you put in. So you need to risk limit. If something isn't good, just look for something else that will compensate. If you risk take, just find something that risk limits. But this comes with practicing more than anything else. So even if these patterns tend to be very rare, and they actually are, okay, they still exist. There's generally one accumulation for one third range boundary. There is one accumulation for 1.5 range boundary, third range boundary, okay? So it's a rarer structure, but the risk-reward ratios are far, far better than a third range boundary. This is where you really want to start to expose your capital, but not that much. Generally, you're going to trade for 1 to 1.5% risk because you're still in the range. Therefore, the trend emergence is still not there. And don't be a fool to think that every accumulation will trigger a breakout. It's definitely not the case, okay? So this is where you get to risk take, expecting a breakout to show up, no more than that, okay? If the trades succeed, rule number 1, let it open as much as possible. Don't try to partial profit take these things. These are just there to either fail or succeed. And there's no in-between stuff. The only in-between risk management you make is lowering the stop loss sizing right on to break even. And don't be dumb. Don't use these trailing stop loss whatever shit I see some people using. Absolutely the worst possible thing to do into trading and trend following. Put the stop at break even and forget about this trade for as long as possible. I teach you later on when to profit take these trades manually, okay? So anyway, that's really important for you to understand. This is also the only pattern we trade within the trend channel. It's the only one. I mean, the pullbacks can in some cases, but not most of the cases. So yeah, this pattern trades in the trend channel. What you need is a confirmation. Don't forget about the little triangle. If you trade without it, no good. Okay, you don't trade just the trending signal. Okay, you need the trending signal first and the confirmation, the price reaction. That's absolutely important that you guys understand that. If you do it differently, you say, all right, we're on the trend channel. I've got a trend signal. I'm getting in. You just forgot about confirmation. That's an absolutely mandatory stuff out there, okay? Just don't forget that sometimes the indicators will do an imperfect job, and they will sometimes do not detect the pattern automatically, and you're going to have to work it all out, okay? Sometimes the pattern will be imperfect as well. You won't get the trending signal, but if you've got a cycle breakout, for example, and a ranging signal, that can be appropriate to consider a valuable signal as well, okay? Best case scenario is if it shows up with a Fibonacci cluster area, okay? So all of those things are practical stuff, and we're going to work these out, okay? As we'll make the daily forecasts, the live show, live rooms into Discord, we'll get to use these patterns over and over again into real-time market conditions, and I'll teach you how to safely bend some of the rules. So when you get to learn the pattern, look for the perfect signals as much as possible. If the signals looks to shadow areas, stuff like that, you feel like you don't really know what to do, just do nothing and wait for the breakouts, okay? Breakout is what we're going to be talking into the next video. That being said, I wish you guys a pleasant day.